Hi guys! For this video presentation, let us talk about the conceptual framework for financial reporting. Now, the conceptual framework for financial reporting deals with the following. So these are the coverage. The objective of general purpose financial reporting, the qualitative characteristics of useful financial information. So these include the fundamental and enhancing qualitative characteristics, a description of the reporting entity and its boundary, the definition of the elements of financial statements, which include the asset, the liability, the equity, income, and expenses, and the guidance to support these definitions. Also, the criteria for including assets and liabilities in the financial statements and the guidance on when to remove them. So basically, the conceptual framework for financial reporting also covers when to recognize and when to derecognize assets and liabilities, measurement basis and guidance on when to use them, concepts and guidance on the presentation of financial statements, and also the disclosure needed. And lastly, the concepts relating to capital and capital maintenance. Now, what is the objective of general purpose financial reporting? So the very objective of the general purpose financial reporting is, of course, to provide financial information to users. Okay? To provide financial information to users that will be helpful to them in making or arriving at a sound decision, which relates primarily to providing resources to the entity. Okay? That is why the primary users of financial statements are those which or those who provide financial resources to the entity. This includes the creditors and lenders, and the investors, and the owners. So they are the ones who are considered as primary users because they provide financial resources or resources to the entity. Also, general purpose financial reporting is also important to other users of financial information, such as suppliers, the government, etc. Because they also have stake with the company. They are also considered as stakeholders, and they also need to uh, make sound decisions, especially when they have dealings with the company. Next, we have the qualitative characteristics of useful financial information. Now, there are two categories of qualitative characteristics. We have the fundamental and the enhancing qualitative characteristics. Now, the fundamental qualitative characteristics relate to how the financial reports should be prepared. Whereas the enhancing qualitative characteristics provide for the characteristics which should be present in order to enhance the presentation of financial reports. So, in other words, the fundamental qualitative characteristics relate to the preparation of financial reports, whereas the enhancing qualitative characteristics relate to the presentation of financial reports. Okay, so for the fundamental qualitative characteristics, we have the relevance and faithful representation. Now, in order for an information to be relevant, of course, it must be capable of affecting the decisions of the users. Otherwise, why will you include in the financial reports information that is irrelevant or that is of no use to the users of financial reports? Financial information is capable of making a difference in decision if it has predictive or confirmatory value. So relevance encompasses predictive and confirmatory value. In other words, in order to achieve relevance, such information should be able to predict or anticipate future outcomes. Whereas, once we say confirmatory value, it of course helps users to confirm or to check earlier predictions made. Also, we have faithful representation. What do we mean by faithful representation? Information must be faithfully represented. The substance of what it purports to represent is more important than its form. A faithful representation is, to the maximum extent possible, complete, neutral, and free from error. Okay, in preparing your financial reports, you must include everything that must be included. It must be made objectively. It must be prepared objectively and free from material error. Also, a faithful representation is affected by level of measurement of uncertainty. So next we have the enhancing qualitative characteristics. Again, this talk about the presentation of financial reports. We have the concept of comparability. In other words, in order for your financial statements or financial reports to achieve comparability, the company or the users in particular must be able to compare it with other reports, may it be internal or those coming from from companies with similar nature of doing business, and be able to compare them in order to arrive at a decision. Verifiability. Whatever is in the financial reports must be capable of being verified. In other words, there must be evidences to support whatever is presented in the financial reports. Next, timeliness. Okay, users cannot wait for the accountant to issue the financial reports. It must be given regularly, and when asked with an interim report, the company must be able to furnish such. Because kung mag-i-invest sa inyo sa company at kailangan ng financial reports, you cannot tell them that they should wait for how many months before you issue such report, because the decision of the investor cannot be basically be held, or the investor cannot be kept waiting. Also, understandability. Your financial reports must be understandable, not very complex. It must be capable of being understood by an accountant or even by those with basic knowledge in accounting and finance. Otherwise, kung yung kumpanya lang yung nakakaintindi ng financial report nila, then it cannot be useful to those users. Now, qualitative characteristics also encompass the concepts of cost constraint, prudence, measurement uncertainty, and substance over form. Once we say cost constraint, The benefit of providing such financial information through the financial reports should justify the cost of issuing or using such information. So this is the concept of cost benefit. So dapat you generate general purpose financial reports because it will benefit your company more than what it will cost the company. Prudence. Now the concept of prudence is fairly simple. It is the exercise of caution. When making decision, you should always consider the uncertainty. Prudence implies that assets should not be overstated and liability should not be understated. But the International Financial Reporting Standards actually defines prudence as that which does not allow for overstatement of or understatement of assets, liabilities, and even income or expenses. In other words, prudence also implies neutrality. Next, we have a measurement uncertainty. So accordingly, measurement uncertainty does not really prevent information from being useful. Because in some cases, the most relevant information may have such a high level of measurement uncertainty that the most useful information is information that is slightly less relevant but is subject to lower measurement uncertainty. For example, when a company is already uh, doubtful as to continuing its or as to continue its business, in other words, the going concern concept is already doubtful, the financial statements are generally not adjusted to reflect the uncertainty. But what the company does is only disclosure, providing information about the uncertainty. Also, it also provides information about the recoverability and classification of the assets. But still, it does not adjust the accounts to reflect the uncertainty. Only it discloses such uncertainty. So in other words, there are information which has a high level of measurement uncertainty. Nevertheless, such information is still considered to be reported because they are useful to the users of financial information. Lastly, we have substance over form. Simply, transactions should be recorded considering their substance, the substance of the transaction over their apparent form. So in simple terms, we record to consider substance over form. We recognize transactions. We record transactions based on what really transpired, what really happened, not on what is the title of the transaction. We look to the meanings of the context of the contract. If there is a contract involved, we ignore the title of that contract and just read over the content of the contract and understand the contract. And from there, we record the transactions, what transaction really transpired. For example, a company uh, rents a property to another company. Okay, but there is an agreement that at the end of 5 years, company B, company A rents a land to company B, and you account it only as an operating lease. But thereafter pala, after 5 years, it will be owned by Company B. So it may not be an operating lease at all. It may be a finance lease. Even if the contract says it's a mere renting, if ownership will be transferred to Company B after 5 years, then it's not as simple as renting. Okay? So that's the concept of substance over form. Financial statements and reporting entity. Reporting entity, an entity that is required or chooses to prepare financial statements. Very self-explanatory. Financial statements is, these are the particular forms of financial reports that provide information about the financial health, the financial performance or condition of the company. The elements of financial statements. We have the elements of the statement of financial position. We have the assets. These are, asset is a present economic resource controlled by an entity as a result of past events. So in other words, may nangyaring event bago na-acquire ang asset na ito, or may nangyaring past event before the entity acquired ownership or controlled or was able to control that particular economic resource or asset. For example, the past event can be purchase of equipment. So prior to owning the equipment, may bilihan muna dapat na naganap. An economic resource is a right that has the potential to produce economic benefits. So of course, assets, in order to be recognized as assets, they should provide future economic benefits or potential to produce economic benefits. As opposed to liabilities, liabilities are present obligations of the entity. Okay, liabilities commits resources or commits the transfer of economic resources as a result of past events also. And for example, there was a contract of loan. Hence, a recognition of a loans payable. An obligation is a duty or responsibility that the entity has no practical ability to avoid. Yun nga, there is a commitment, there is an obligation to commit the economic resources of the company in order to pay such liabilities. Equity has a residual definition. It is the residual interest in the assets after deducting the liabilities. That's why our accounting equation is assets is equals to liabilities plus owner's equity. If we are going to remodel that, it will be equity is equals to assets less liabilities. Also, the elements of statement of financial performance, we have the income and expense or income and expenses. Income increases assets or decreases liabilities that result in increase in equity other than those relating to contributions from holders of equity claims. So very self-explanatory. Income are those cash inflows or what you call this, benefits, economic benefits of the entity that may either increase the assets, naka-receive ng cash because of services rendered, or decreases liabilities. For example, an unearned service revenue being derecognized because services are already rendered. That result in increases in equity because income increases owner's equity. Relating to contributions, or other than increases equity other than those relating to the contributions of the owners. Whereas expenses decreases assets. Say for instance, you pay utility bills, or increases liabilities. You incurred the expense, but you did not pay it yet. That results in the decrease in equity other than those relating to distributions to holders or equity claims. Concepts of capital and capital maintenance. So the concepts of capital and capital maintenance encompasses the financial concept and physical concept. So the financial capital maintenance is what we normally use. A financial concept of capital is one which the capital of the entity is linked to the net assets. That's why we have assets minus liabilities is equals to equity. As opposed to physical capital maintenance, this is rather complex. A physical concept of capital is one where the capital of the entity is regarded as its production capacity, meaning profit is only considered as earned if the physical production capacity of the entity at the end of the period is greater than that of the production capacity at the beginning of the period. Of course, with adjustment to the distributions paid to the owners during that period. But what we use actually is the financial concept. Okay, so that's all for this video presentation. Thank you very much.